Hello friends, today I am going to talk about GST Input Tax Credit. Many businesses automatically classify GST Input Tax Credit as a current asset. But is that always the right approach? In this video, I will dive into the criteria for determining whether GST Input Tax Credit should be treated as a current or non-current asset. By end of this video, you will have a clear understanding of how to accurately classify GST input tax credit on your balance sheet and ensure compliance with accounting standard. If you are new to my channel, request you to subscribe to the channel. So let's start. Let's start with the first scenario. Input tax credit is allowed. That means the government is allowing the company to claim all the taxes paid to the vendors and adjust those taxes against the GST liability which will be charged to the customer at the time of sales. So there are two different type of taxes which are applicable in India. One is direct tax and one is indirect tax. Under direct tax, one example is income tax, where the company pays tax on the income earned for a particular period or for the year. Whereas in case of indirect tax, that is called as GST, goods and service tax, this tax is applicable only on sale of goods and services. Now let's start with the example where I am going to explain you how the input tax credit is adjusted with the GST liability. For example, there is a supplier and he is supplying material to the customer. And here you can see the invoice breakup. Invoice breakup has two components. One is material cost and one is GST. So material cost is 1 lakh. GST at the rate of 18%, so it is 18,000, and invoice value is 1,18,000 including GST. Now when this material is received by the customer has to account this, right? So when customer accounts this, customer is hitting the inventory account by 1 lakh rupees and tax credit by 18,000. So here if you see, the inventory cost is not 1 lakh 18, the inventory cost is 1 lakh. Why? Because the 18,000 tax what the customer is going to make payment to the supplier, the customer can claim this as input tax credit, right? So it's just like an asset for the company. So tax credit 18,000 and invoice value is 1 lakh 18,000. Now when the customer is receiving this raw material, the purpose is not to sell the raw material, right? The purpose is to convert the raw material into a finished goods. So what is the next step? The customer is processing these raw materials, and while processing, there will be some other cost which will be loaded to the inventory cost. So the cost of goods manufactured will have inventory of 1 lakh, other expenses 10,000, labor cost 20,000, and total production cost is 1 lakh 30,000. Now this product, now the customer is selling to the customer, to its own customers, and at what price? It is 1 lakh 50,000. So what is the profit the customer is earning here? 1 lakh 50 minus 1 lakh 30, the production cost, net profit is 20,000. Now when the customer is raising the invoice to its customer, the invoice breakup will be revenue 1 lakh 50,000, GST liability at the rate of 18%, which comes to 27,000, and total invoice value will be 1 lakh 77,000. So what's happening here? The input tax credit, what is paid by the customer to the supplier is 18,000, but what is charged to the customer's customer is 27,000. Now, what amount now this customer is going to make payment to the government? So the GST what to be paid will be GST liability 27,000, which is charged on the invoice to the customer's customer, less the tax credit. That means the amount what is paid to the supplier, that is 18,000, and net amount, that is the net amount of 9,000 will be paid by cash because there is no tax credit available beyond 18,000 rupees. Hope you have understood this flow. In the next slide, I'll talk about how the accounting entries will be posted in the accounting ERP. Now let's try to understand the accounting part for the cases where input tax credit is allowed. So the first accounting entry will be for the invoice received from the supplier and accounting of inventory and tax credit. So if you see the invoice breakup, you have inventory 1 lakh, tax credit 18,000, and total invoice value is 1 lakh 18,000. Here 18,000 of GST what is paid to the vendor is claimable as input tax credit. Hence, we have to account that in a separate general ledger, not to be loaded to the inventory. So what is the accounting entry here? Inventory account debited 1 lakh, GST Input Tax Credit account debited 18,000, to vendor account 1,18,000. Now the GST what we have accounted here will be reported under assets in balance sheet, right? Because it is just like a prepaid expenses type, right? You have paid in advance to the government, you will be adjusting with the GST liability. Coming to the sales part, when the customer raises sales invoice on 4th February 2025, revenue 1,50,000, GST liability 18%, that is 27,000, and sale value is 1,77,000. And what is the accounting entry to be posted here? Customer account debited 1,77,000, to GST liability 27,000, to sales 1,50,000. Okay, and this GST liability tax will be reported as liability in balance sheet. Now, when the company is going to make payment to the government, what the company is going to do here? The GST liability, what the company has to pay is 27,000. Less tax credit, which was reported as asset in the balance sheet, will be netted off. That is 18,000. So the net amount of 9,000 will be paid to the government. So what is the accounting entry here? GST liability account debited 27,000, to GST input tax credit account 18,000, to bank 9,000. So this is the amount which will be paid by cash. And after this entry, no GST liability and input tax credit will be reported in the balance sheet because both are nullified. There is no balance outstanding in both ledgers. Now let's try to understand scenario 2 where input tax credit is not allowed. So in scenario 1, we saw the example for input tax credit where it is allowed. That means the company pays tax to the vendor and the same tax can be claimed as input tax credit and the same amount can be adjusted with the GST liability. Now in this scenario, we'll try to understand what happens when the input tax credit is not allowed. That means the government doesn't allow the customer to claim the tax paid to the vendor. So I'll take the same example so that you can connect with the numbers. So supplier is raising the invoice, metal cost 1 lakh, GST 18%, that is 18,000, invoice value 1 lakh 18,000. Now when the customer will receive this material and account it, what accounting the customer is going to do? The inventory here, if you see, has increased by 18,000 because tax credit is not allowed. Hence the 18,000 GST paid to the supplier will be loaded to the inventory cost, right? Now because of this extra amount loaded to inventory, the profitability of the company will also get impacted unless the selling price is changed. Now the customer process this raw material and converts to finished goods. Obviously there will be additional cost for that. So cost of goods manufactured is inventory 1,18,000, other expenses 10,000, labor cost 20,000, and total production cost is 1,48,000. And what is happening to the profit now? In scenario 1, the profit was 20,000 because the tax credit of 18,000 was allowed. Here the tax credit is not allowed, hence the cost has increased by 18,000 and the profit, which was 20,000 in scenario 1, now dropped to 2,000. And when the invoice is raised, the invoice breakup is 1,50,000, which is sales, GST charged at the rate of 18%, that is 27,000, and the sale value or the invoice value will be 1,77,000 rupees. Now question is, how much to be paid to the government? Whether 27,000 or is there any tax credit which can be adjusted and net amount to be paid? So the answer is there is no tax credit because the government doesn't allow to take input tax credit in this scenario. So 27,000 rupees which is charged to the customer, the end customer, same 27,000 will be paid to the government. So this is how the process will change when the input tax credit is not allowed. In next slide, I will talk about the accounting impact. Now let's try to understand how the accounting entries will change compared to scenario 1. So when the material is received, the inventory cost is 1,18,000, right? Because there is no tax credit. So what is the accounting entry? Inventory account debited 1,18,000. GST input tax credit debited 0 because you are not taking any credit. So even though it is 0, I have shown here as the entry so that you understand how it impacts. To vendor 1,18,000 rupees. So what is happening here? GST input tax not reported under assets in balance sheet as input tax credit is not allowed. There is no amount to be reported. Coming to the second entry at the time of sales, it remains same what we have seen in case of scenario 1. So the entry is customer account debited 1,77,000, to GST liability 27,000, to sales 1,50,000. And what is happening here? GST liability tax reported under liability in balance sheet. Now, while making payment to the government, GST liability 27,000 has to be paid in complete amount, that is no net of tax credit, because there is no amount to be adjusted. So what is the entry here? GST liability account debited 27,000 to GST input tax credit account 0, because there is no utilization, right? To bank 27,000 rupees. So by this example, you can understand that the full GST liability is paid as there is no input tax credit available for utilization. So as of now, we have understood what is the meaning of input tax credit, how it is adjusted with GST liability, and if there is no input tax credit, how its impact to the cost of the inventory. In this slide, I am going to explain you about classification of input tax credit into current and non-current. So in what situation we have to report the tax credit as current, and in what situations we have to reclassify to non-current. So let's take scenario 1 where we were allowed to take input tax credit. So here, if there is a situation that the utilization chances is in next 12 months, that means whatever tax credit has been accumulated in the balance sheet and on the reporting date, you can estimate that the utilization is possible in next 12 months, then how we are going to show the tax credit, let's see. So what's happened here? Management ensures that all raw material purchased will be sold to the customers within 12 months, right? That is the assurance that what the management feels. So in that case, as the GST liability is higher than the GST input credit, the input tax credit can be completely utilized within 12 months, right? So what is happening? If your liability is higher and your input credit is lower, you can completely utilize and knock off with the GST liability. So what you are going to show? You are going to show current assets. Why? Because in 12 months, you are going to utilize complete amount, whatever you have accumulated on the reporting date. Now, second scenario, utilization chances in next 12 months is no. That means the probability of utilizing the tax credit, whatever is accumulated today, in next 12 months is very less. And what is the scenario here? Management believes that the sales demand will reduce and may not utilize all GST input as paid to the vendors. That means the sales is falling down, the demand is reducing from the customers. So the GST liability, what the company is going to pay in next 12 months will be lower than the input tax credit, what is accumulated today, right? So what is happening here? As the sales projection has reduced, the utilization of GST input tax credit will be limited. Management has to check the sales forecast for next 12 months and calculate the maximum tax credit which can be utilized. So what will happen here? We have to show that portion as current assets which can be utilized in next 12 months based on the sales projection what the company has for next 12 months. Now, the remaining amount which cannot be utilized in next 12 months but management believes to be utilized after 12 months will be treated as non-current assets because the company can't utilize in next 12 months. So we can't show as current assets. Now, in case of scenario 2, where input tax credit is not allowed, as the GST input tax credit is not allowed, the GST paid to the vendor is capitalized with inventory cost. There is no need of classifying into current non-current because no tax credit is availed by the company. Now, let's try to understand scenario 3, where input tax credit is allowed, but GST liability percentage is lower than input tax percentage. That means when you're paying to a vendor, the tax applied by your vendor on you is higher than the GST liability what you charge on your customer. So let's understand through an example. I'll take the same example so it is easier for you to connect the numbers. So supplier here issuing the invoice, material cost 1 lakh, GST 18%, 18,000, invoice value is 1 lakh 18,000. As GST credit is allowed, the customer is going to record the inventory for 1 lakh rupees and pass a entry for tax credit 18,000 because credit is allowed and total invoice value is 1 lakh 18,000. Now the customer process the raw material to finished goods. So there is a conversion cost. So inventory 1 lakh, other expenses 10,000, labor cost is 20,000, production cost is 1 lakh 30. And the customer is selling to its customer at 1 lakh 50,000 rupees, earning a profit of 20,000 rupees. Now, the catch here is that at the time of sell, that finished goods falls under a lower slab of GST liability. So here revenue is 1,50,000, which I am keeping same compared to scenario 1 and 2. But the GST liability is 5%. That means the amount what you're going to charge to your customer is 5% on the sell value, that is 1,50,000. That comes to 7,500, and total sell value now is 1,57,500. So what's happening here? The customer has paid 18,000 to its supplier, but when the customer is selling to its retail customers, it is charging only 7,500, which is lower than 18,000 rupees. So what is happening in this case? The GST to be paid to the government is GST liability 7,500 less tax credit 7,500. So no cash is paid, right? Now we'll understand in accounting form in the next slide. Now let's understand the accounting part. So when the invoice is received by the customer, the account entry remains same like scenario 1. Inventory account debited 1 lakh, GST input tax credit 18,000, to vendor account 1,18,000. And what's happened here? GST input tax 18,000 reported under assets in balance sheet. Second entry is same, revenue 1,50,000, but here the GST liability has been reduced to 5%. So what is the accounting entry here? Customer account debited 1,57,500, to GST liability 7,500, to sales 1,50,000. So GST liability will be reported as liability in the balance sheet. Now, when it comes to payment, as the GST liability is lower than the input tax credit, the GST liability 7,500, it's adjusted with tax credit of 7,500, and no cash payment is made to the government. So what is the accounting entry here? GST liability account debited 7,500, to GST input tax credit 7,500. Unutilized input tax credit of 10,500, that is 18,000 minus utilized now 7,500. So unutilized is 10,500, is reported in the balance sheet as an unutilized tax under assets. Now let's try to understand in scenario 3 how to classify the input tax credit, the 18,000 what we have paid to the vendor, how it will be classified into current and non-current. So we'll take the similar case, utilization chances in next 12 months. The probability is yes. That means management ensures that there could be launch of new products where higher GST liability is applicable and unutilized tax credit can be adjusted with a new product. Because the current existing product only considers 5% as GST. So in any case, you can't utilize complete amount. But management believes that they're going to launch a new product which may attract higher GST liability. In that scenario, the company can utilize the unutilized portion which is reported in the assets, right? If that is the situation, as the GST liability is higher than the GST input credit, new product will be launched. The input tax credit can be completely utilized within 12 months. So that's the scenario. So it's very clear. Then we have to report that as current assets because management believes that if not with the current product, with future products, that is possible to utilize in next 12 months time. Now, second case, utilization chances in 12 months, next 12 months is very less. Okay, what happens here? Management believes that the GST liability rate will not change and GST input credit cannot be utilized, right? Because you are holding a bigger amount and the liability is smaller amount, you can't utilize it. So what's happened here? As the GST liability percentage is lower and input tax credit percentage is higher, the company will start accumulating the unutilized input tax credit in the balance sheet. So what to do now? So the company has to take a provision for unutilized portion. The company has to take provision for the unutilized portion of GST input tax credit. And another option is to load to the inventory cost. The management can estimate the percentage of GST input credit which cannot be utilized and load to the inventory at the time of accounting. Now let's try to understand scenario number 4. In different situations, how the input tax credit is classified into current and non-current. So the first one is greenfield projects where input tax credit on assets and investments allowed, however, can be utilized once production starts. So similarly here, utilization chances in next 12 months, the answer is yes. That means production will start within 12 months from the reporting date and management believes that all input credit accumulated till date can be utilized within 12 months. So if that is the scenario, it has to be treated as current assets. Now, utilization chances in next 12 months is no. That means management believes that the sales after production within 12 months from the reporting date may not utilize all GST input tax paid to the vendor. Right? What's happened here? As the sales projection has reduced, the utilization of GST input tax credit will be limited. So management has to check the sales forecast for next 12 months and calculate the maximum tax credit which can be utilized. So whatever you can utilize in next 12 months based on your sales from projection, it will be treated as current assets, and whatever balancing amount will be treated as non-current assets because you can't utilize them in next 12 months time. Coming to the second point, input tax credit, lack of documentation. The management has taken the tax credit in balance sheet, but not yet utilized as sufficient documentation is not available. So what's happening here? It will be treated as non-current assets. So there is no certainty that the company can utilize within 12 months. Very good example I can talk about is like airlines input tax credit. So sometimes the department asks you to collect the invoices which is issued by airlines, which is a very tough job to do it. So in that case, you would have posted entry to tax credit, but you have not utilized and you are waiting for collecting the invoices from the airlines, which is a tedious job. And if the management believes that it takes more than 12 months, then he can classify those tax credit as non-current assets. Coming to next point, that is disputed input tax credit. The management has taken the tax credit in balance sheet, but the same has been challenged by the tax department. So in that case, it will be treated as non-current assets. There is no certainty that the company can utilize within 12 months. If the risk is high, then the management can take a provision on this unutilized tax credit. So that's it from my side. If you have a different situation where you want to take a call, whether it is current or non-current, then please write down in the comment box. So I'll go through it and I will help you out how to classify into current, non-current. Thanks for watching this video. And if you have not subscribed to my channel, request you to subscribe to the channel. Share with your friends so that they understand how to classify tax credit into current and non-current assets.